So if you've been glued to the market tickers this week, you're probably nursing a pretty serious case of whiplash.
Oh, absolutely. It has been a wildly volatile few days.
Yeah, I mean, it honestly feels somewhat schizophrenic out there right now. Like, one day, a single blog post about something called Agentic AI goes completely viral, and suddenly major stocks, we're talking Uber, MasterCard, are just nosediving.
Right. And then, literally 24 hours later, a hardware partnership gets announced and the whole market rallies like the panic never even happened.
It's crazy.
It is. But it's a fascinating, if somewhat dizzying time to be paying attention to this space.
Exactly. And that is basically our mission for this deep dive. We really need to decode this current AI shift that we're seeing.
Because it's about much more than just the day-to-day stock movement.
Yes, exactly. We aren't just looking at the stock tickers here. We want to show you how the literal infrastructure of the internet is being rebuilt from the ground up.
And why this whole agentic concept is absolutely terrifying to software CEOs.
Right. And in a really weird twist that we'll get to at the end, why chocolate bars are suddenly being locked up in anti-cuffed boxes over in the UK.
It is quite the spectrum of news today.
It really is. And we've pulled all this from a massive stack of sources, heavy financial reports, corporate announcements from companies like Meta, and even some pretty stark warnings from the CEO of JP Morgan Chase.
We're going to try to connect all these scattered data points into a cohesive picture for you, because there really is a through line here.
Awesome. So I want to start with the hardware, because that seems to be where the real money, and let's be honest, the real drama is moving right now.
The foundation of it all.
Right. So for a long time, NVIDIA has been the undisputed king of the hill in AI chips. But this week, Meta Platforms made a move that suggests the king's crown might be slipping, or at least that Meta is tired of bowing down.
Well, I think it's less about overthrowing the king outright and more about, making sure the king doesn't have absolute leverage over your kingdom.
You're talking about the massive deal with AMD.
Exactly.
According to the reports, Meta has signed a multi-year agreement to deploy AMD Instinct GPUs. But the scale here is what really caught my eye. They are talking about deploying up to 6 gigawatts of compute, which is just...
We really need to pause on that number, 6 gigawatts.
Yeah, it's hard to even picture what that means.
To put that into perspective for you, that is roughly the power consumption of a small industrialized country.
Wow.
Yeah, this isn't some pilot program or a little R&D test run. This is a massive structural infrastructure commitment by Meta.
And here's where it gets really interesting financially. It's not just a standard purchase order, right? There is a performance-based warrant involved in the deal.
Yes, there is.
Can you break down what that actually means for Meta?
It's a sweetener, but a highly strategic one. Essentially, Meta has the option to acquire up to 160 million shares of AMD if certain performance targets are met by the hardware.
So they get a piece of the upside.
Exactly. This is crucial because it aligns their incentives perfectly. Meta isn't just blindly buying chips, they are effectively betting on AMD's stock price and their technical success.
Like they're an investor.
Right. They are engineering a competitor to NVIDIA by saying, we will buy your product at a country-sized scale, and if it works the way we want a piece of your company.
Which makes the timing of all this fascinating. We know Meta is receiving early shipments of the MI450 chip, which is AMD's new heavy hitter later this year, but didn't Meta just announce that they were actually expanding their NVIDIA clusters too?
They did, yeah.
So isn't that contradictory? Like buying more NVIDIA while heavily betting on AMD at the same time?
It seems like it, but not in this market. It's classic leverage. I mean, Meta relies on NVIDIA heavily right now, which is a massive business vulnerability.
Because NVIDIA basically dictates everything.
Right. NVIDIA sets the price, and NVIDIA controls the supply chain. By bringing AMD into the fold at this 6 gigawatt scale, Meta creates immediate, localized competition.
They are signaling to NVIDIA, look, we have options, so don't get too comfortable.
Precisely.
But does that leverage actually threaten NVIDIA's bottom line right now? Because despite Meta kind of cheating on them with AMD, the consensus expectations for NVIDIA are still insane.
They are.
They're pointing to 68% revenue growth, hitting something like $66 billion. Morgan Stanley literally just reiterated an overweight rating on their stock.
Right, so in the short term, no, the party absolutely continues. NVIDIA is still selling every single H100 or Blackwell chip that they can manufacture, but the narrative cracks are starting to form.
What do you mean by narrative cracks?
Well, investors are starting to whisper about CapEx skepticism.
Which is just fancy financial talk for how long can you keep spending billions of dollars on chips before you actually need to see a profit?
Hit the nail on the head. The question floating around is is this peak spending? And if the hyperscalers, Meta, Google, Amazon, if they start leaning heavily on custom ASIC competition or deep partnerships with AMD, NVIDIA's moat gets a little shallower.
So the fear isn't that NVIDIA collapses tomorrow.
No, not at all. The fear is that their margins get squeezed by massive customers who suddenly have viable alternatives.
Got it. And all these chips, whether they are red team AMD or green team NVIDIA, they physically need a place to live.
They do. They generate a lot of heat and need a lot of power.
Which brings us to the physical toll of this boom, the data centers. The numbers coming out of JLO Jones Lang LaSalle are frankly absurd to me.
They are completely disconnected from the rest of the commercial real estate market right now.
Yeah, they reported that North American data center vacancy is at 1%.
1%.
That's effectively zero. That means if you want space, you literally cannot find it.
You really can't. And this is for the second year in a row that the market is basically sold out.
Wow.
But the stat that really emphasizes this whole land grab mentality is looking at the future. 92% of the capacity that is currently under construction is already pre-leased.
92%. So if you decide today, as a company, that you want to build a massive new AI model and you need a data center to do it, you are already, 2 years too late?
At least. Unless you planned it years ago, you're entirely out of luck. And this insatiable demand is actually shifting the physical geography of the internet.
How so?
Well, Texas is on track to overtake Virginia as the largest data center market in the country.
Really? Because Virginia has been the hub forever.
Exactly. But the sheer power grid demands and the land requirements of these hyperscalers are pushing the infrastructure engine room to places like Texas, where they can still build fast and secure enough power.
It's just wild to think about the physical dirt and concrete being poured out in Texas, just so we can have, slightly smarter chatbots.
It is a massive physical footprint for a digital product.
But speaking of smarter bots, let's pivot to the panic part of our deep dive. Because while the hardware folks are clearly popping champagne down in Texas, the software folks seem to be actively hyperventilating.
Yes, this is the Agentic AI narrative.
Right, and it all started with this widely read Substack post. Some people were calling it a doomsday scenario.
It's crazy how much power one piece of writing can have in a jittery market.
Seriously, this thing dropped, and suddenly major blue-chip stocks were just tanking. We saw Uber, MasterCard, American Express, DoorDash, all of them dropping 4 to 6% in a day.
Well, to be fair, it wasn't just the article itself. The article gave a very clear voice to a fear that has been building quietly in the background for months.
The fear of agentic AI.
Exactly.
We hear agentic AI thrown around a lot.
Yeah.
But let's clarify the actual mechanism of the threat here for everyone listening. Why does an AI agent suddenly hurt a massive company like Uber?
It's all about the interface layer. Think about how you use Uber today.
I open my phone, tap the app.
Right. The app is the king. You open Uber, you see their specific branding, you see their ads, you see their surge pricing. You are in their ecosystem.
Sure.
In an agentic future, you don't use the app at all. You just tell your personal AI assistant, get me to the airport. Then your AI negotiates with Uber, Lyft, Waymo, and maybe even local taxi services in the background. It books the absolute cheapest or fastest one, and it handles the payment invisibly.
So the app itself just becomes invisible to me.
Precisely. It becomes a dumb pipe for the service.
Oh.
And that threatens to totally commoditize the service providers. If the AI is the one acting as the customer, brand loyalty completely disappears.
Because my AI doesn't care if the car has a pink Lyft mustache or an Uber sticker. It just wants the $12 ride instead of the $14 ride.
Exactly. That is why Uber and DoorDash took such a hit. If an agent automatically negotiates the absolute lowest price for your burger delivery, DoorDash's margins could get squeezed to almost nothing.
That makes total sense. And it wasn't just the gig economy apps that got hit either. This panic spread to huge business software companies too.
It did. The enterprise space got spooked.
Yeah, we saw Salesforce, Workday, Snowflake, Intuit. They all faced this sudden valuation compression.
Because the market is starting to ask a very dangerous question for these companies.
Which is,
if AI can write custom code and manage databases perfectly well on its own, do we actually need to pay for these incredibly expensive bloated SaaS subscriptions anymore?
that is a terrifying question if you're a software CEO.
It really is.
There was one casualty in all this that really stood out to me just because it felt so specific. IBM. They dropped 13%. And the reason wasn't about chatbots taking over customer service. It was specifically about COBOL.
The ancient language of the mainframes.
Right. For those who don't know, COBOL is this decades-old programming language that still basically runs the world's banking systems.
It handles an enormous amount of daily financial
Now,
transactions.
IBM makes an absolute fortune just keeping those legacy systems running, mostly because nobody knows how to fix that code anymore.
Until now, or at least so the new narrative goes, an AI tool recently demonstrated the potential to modernize COBOL systems automatically.
So if an AI can just translate this ancient hieroglyphic code into modern Java or Python in a few seconds, IBM's massive maintenance business just evaporates.
That was the knee-jerk reaction from the market, hence the 13% drop.
Is it actually that simple, though?
No. Now, to be fair, analysts came out a bit later and added some much-needed nuance. They said, look, AI isn't going to replace the mainframe franchise outright overnight.
Right, because these systems are mission critical.
Exactly. You don't just let a random bot rewrite your entire banking core on a Tuesday afternoon and hope for the best.
No, that sounds like a recipe for a global financial meltdown.
But the sudden drop in IBM stock shows just how jittery investors are right now. They are actively hunting for the next victim of AI competence.
And they found another one in the cybersecurity sector. CrowdStrike, Zscaler, Okta, Palo Alto Networks, they all slid.
Yes, and this was triggered directly by Anthropic.
Because they unveiled something called Claude Code Security, right?
Right. It's a tool that scanned code bases and proposes security patches automatically.
Which, on the surface, sounds great. I mean, who doesn't want perfectly secure code?
It is fantastic for developers. But for companies whose entire business model is selling standalone security tools, it's a nightmare.
Ah.
The market is worrying that if the AI that is building your software can also automatically secure your software, then the need for third-party security platforms diminishes massively.
It's the classic fear that features are going to eat standalone products.
Exactly.
But, and here's where the whiplash we mentioned earlier really comes in. The panic actually didn't last forever. The markets rebounded.
They bounced back surprisingly fast.
The S&P 500 went up 0.77%. AMD, like we talked about, jumped almost 9% on that Meta deal. And those battered software stocks actually started to recover.
That's because the AI companies themselves, specifically players like Anthropic and OpenAI, realized they were scaring the money away.
They became the boogeyman.
Right. And they needed to urgently change that narrative. They had to prove, hey, we aren't destroyers, we are partners.
An olive branch to the software industry. And we saw that with Anthropic rolling out what they called Claude Cowork, which I have to say, I love the name. It sounds so friendly and unthreatening.
It is very intentional branding.
They announced deep integrations with Slack, Gmail, Intuit, DocuSign, FactSet.
So instead of replacing a tool like Slack, Claude just lives comfortably inside of Slack.
Making Slack better rather than obsolete.
Right. And that really helped lift those software stocks back up. It reassured investors, easing the fear of wholesale displacement. It showed that these existing tools will likely be the container for AI, not the victim of it.
That makes a lot of sense. And we saw a very similar partnership strategy playing out in the consulting world.
The human element of the integration.
Yeah. OpenAI signed these huge multi-year alliances with Accenture and Capgemini.
This is a really crucial piece of the puzzle.
How so?
Because OpenAI knows that just having the smartest foundation model isn't enough to actually capture enterprise value. You need to actually deploy it into messy, real-world corporate workflows.
And OpenAI doesn't have the manpower to do that themselves.
Exactly. But Accenture has a literal army of consultants to go into Fortune 500 companies and actually implement these frontier AI agents.
It's the boots-on-the-ground strategy for AI deployment.
And it comes with a necessary reality check, too.
Right, I saw that. Brad Lightcap, the COO of OpenAI, actually came out and admitted that enterprise AI is still early.
Yes, he was very clear that it hasn't deeply penetrated core business processes at scale yet.
Which is basically a polite way of saying, everyone calm down, we aren't taking over the world tomorrow.
Exactly. He emphasized that the goal right now is finding measurable business outcomes, not just fueling hype.
But, you know, even if the absolute AI takeover isn't happening tomorrow, the economic shift is already happening today.
Without a doubt.
Let's talk about the human cost here. Because while the stocks rebounded, the workforce is actively shifting. JP Morgan Chase, literally the biggest bank in the U.S., is executing what they're politely calling huge redeployment plans.
Yeah, redeployment is one of those classic corporate euphemisms.
What does it actually mean on the ground?
What they are saying is that as automation and AI use cases expand across the bank, The routine roles that humans used to do are disappearing.
Right.
They are trying to move those displaced workers into new, higher value roles, but the underlying implication is clear. The bank is getting vastly more efficient.
And efficiency usually translates to needing fewer humans per dollar of revenue.
That is the historical trend, yes.
And it's not just the rank-and-file employees dealing with this. The man at the top, Jamie Dimon, is actually sounding the alarm on the broader economy.
And when Jamie Dimon speaks about the economy, Wall Street usually shuts up and listens.
What exactly is he warning about?
He's giving a very sobering warning. He explicitly says he sees echoes of the 2005 to 2007 pre-crisis era.
Oof. We all know how 2007 ended.
Right. He pointed to a combination of red flags: AI euphoria, record-high market valuations, and high risk-taking in credit markets.
So he thinks we're getting ahead of ourselves.
He's warning that despite the incredibly strong trends we are seeing right now, the 68% growth at NVIDIA, the boom in data centers, we could actually be setting ourselves up for a severe future cycle downturn.
So we are building the technological future, but we might just be building a massive financial bubble at the exact same time.
History would suggest they very often go hand in hand.
And on top of those economic warnings, there is also the regulatory hammer hovering over these banks.
Yes, Washington is paying attention.
The White House is apparently mulling an executive action that would legally require banks like JP Morgan to verify customer citizenship.
That is a significant regulatory curveball.
What's the impact of that?
Industry experts are warning that this kind of mandate could raise compliance costs massively and actually limit consumer access to basic financial services.
So the banks are basically getting squeezed by AI disruption and workforce shifts on one side, and potential sweeping new regulations on the other.
It's never a dull moment in banking.
Never. Okay, I want to zoom out from the AI doom and gloom for a minute, because there is a whole lot of other stuff happening in the broader economy, and some of it is just as dramatic.
Let's look at the media wars.
Yes, the battle for Paramount continues to escalate. Warner Bros. Discovery WBD says that Paramount Skydance raised its takeover offer.
And it's a huge bid.
All cash, $31 per share.
And a $7 billion regulatory break fee attached to it.
That is a staggering amount of money to promise if the government blocks the deal.
It really shows how desperate the push for consolidation is in the legacy media space right now. And the clock is aggressively ticking on this one.
Why is the clock ticking?
Because the board is reviewing this under the existing Netflix agreement.
Wait, Netflix is involved in this too?
Indirectly, yes.
Really?
The agreement allows Netflix just 4 days to match the WBD bid if the board deems it superior.
Wow. It's a high-stakes game of poker with billion-dollar media libraries.
Exactly.
Speaking of high stakes, let's quickly check in on Spirit Airlines. I feel like every time we talk about them, it's bad news.
Well, this update is, I'd call it mixed news.
Oh?
They are officially exiting Chapter 11 bankruptcy. They reached a restructuring agreement with their creditors, aiming for late spring or early summer.
That sounds objectively good, right? They survive.
It is good that they survive, but they are going to emerge as a much leaner airline.
What does leaner mean?
Well, they are cutting their debt load from $7.4 billion down to $2.1 billion.
That's a huge haircut.
It is. But that restructuring means they will be operating a significantly smaller fleet and a smaller overall route network.
So fewer of those bright yellow planes in the sky, but at least they're still flying.
For now, yes.
Now contrast that struggle with Stripe.
Oh man, Stripe. They are the quiet giant of the tech world.
Not so quiet anymore, though. They just launched a secondary share sale that values the firm at $159 billion.
$159 billion. That is a massive number for a company that is still private.
It really is. But it reflects their sheer volume. The reports show they processed $1.9 trillion in payments in 2025.
Which is just staggering scale.
Right. While we spend all our time talking about AI agents supposedly taking over, Stripe is just quietly continuing to be the plumbing of the entire digital economy.
And getting extremely wealthy doing it.
Truly. And quickly, before we get to the chocolate story I promised, a bit of actual good news for anyone using weight loss drugs.
Yes, Novo Nordisk. They are finally cutting the U.S. list prices for Wegovy and Ozempic.
People have been waiting for this.
Well, don't get too excited just yet. They are cutting the price to $675 a month, but the cuts don't take effect until 2027.
2027. That's a really long wait for relief.
It is, but it's a long-term strategic move to compete with Eli Lilly. The duopoly competition is heating up, and prices are clearly becoming the primary weapon.
Okay, so we've covered AI supercomputers, banking layoffs, media buyouts, and airline bankruptcies.
We have covered a lot of ground.
But I promised chocolate at the top of the show. And this one feels like the most Black Mirror detail of the week,
Yeah.
but in a very gritty, low-tech way.
It is a very stark contrast to everything we just discussed.
So over in the UK, major retailers like Sainsbury's and Tesco are starting to put normal chocolate bars in anti-theft boxes.
You mean those clear plastic security boxes they usually use for, like, expensive razor blades or video games?
Yes, exactly those, but for a regular chocolate bar.
Why? Are chocolate bars suddenly worth their weight in gold?
No, it's about a massive wave of organized theft. The stats say there are 5.5 million shoplifting incidents in the UK last year.
5.5 million.
Yes, and it's apparently a surge driven largely by organized crime networks, not just petty theft.
Wow. And it just perfectly highlights this bizarre economic disconnect we are living through.
What do you mean?
Well, on one hand, we are sitting here discussing 6-gigawatt GPU clusters and highly advanced AI agents that can automatically rewrite global banking code.
Right.
And on the exact same day, we are talking about society having to physically lock up a Snickers bar because the basic physical retail environment is deteriorating so badly.
It's a completely wild world right now.
It really is.
So, bringing it all together, what does this actually mean for us? We've got the absolute highest of high-tech breakthroughs happening alongside the grittiest of real-world retail problems.
I think the main takeaway from all these sources is that we are currently sitting at a massive inflection point.
Okay.
We so often think of the economy as just one big monolith moving in one single direction. But right now, it's severely splintering.
How so? Give me an example.
Well, look at the physical tech infrastructure. It is absolutely booming. Data centers are full with zero vacancy, advanced chips are selling out years in advance, and companies like Stripe are processing trillions of dollars. That specific part of the economic engine is roaring.
But then you have the fear side of the equation.
Exactly. You have this palpable agentic fear heavily rattling the software industry, the creeping dread that AI makes current highly valued business models totally obsolete.
And you have Jamie Dimon explicitly warning that the market valuations are running on euphoria, looking just like the setup to the 2008 crash.
Right. It's like we are speeding up the car as fast as it will go, but we aren't actually sure if the road ahead of us is finished being built.
That's a really great way to put it. We are pouring billions upon billions into the engine, the chips, the power grid, the AI models, but we haven't quite figured out if the chassis, meaning the legacy software companies, the employment market, the banking regulations, can actually handle that kind of speed without falling apart.
Precisely. The infrastructure is outpacing the society it's built for.
Which leaves us with a pretty massive, provocative question for you listening to think about this week.
The big takeaway.
If these new AI agents actually do start seamlessly booking our Ubers, securing our networks, and fixing our legacy code, the overall economy undeniably becomes vastly more efficient.
Costs go down and speed goes up.
Right. But Jamie Dimon is warning of blind euphoria. So the question is, are we diligently building a much more efficient, automated future, or are we just inventing a highly complex, incredibly fast way to reach the exact next financial bubble?
That is the multi-trillion-dollar question right there.
Thanks for joining us for this deep dive. Take that thought with you, and we'll catch you on the next one.